Morning, market chameleons. Happy Monday morning. Dima,
Good
good
morning, Will.
morning,
How are
buddy.
you?
Great. It's 9 o'clock. Let's get started right away with the disclaimer. What about
Okay.
that?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent. Just a couple house cleaning issues. Tonight we have a webinar with Felix Frey from Options Geek, and he's going to be looking at unusual option volume for trading opportunities, D.
Cool.
All right.
That's
and
awesome.
I'll put a link in the chat. If you're new to Market Chameleon's morning show, we're on YouTube Live. Put your questions in the chat. We try to get to them. With that, D, what are you seeing this morning?
Let's see. So I think what we'll do is take a quick look what's going on in pre-market hours. Then I want to take a look at Intel's earnings. They reported earnings last week. They're down 9%. Just wanted to take a look really quickly at the fundamentals and point a few things out, see, well, why were they down so much, and get some insights there. We'll also take a look at what's coming up on the earnings front this week, see if how the options are lining up, what they're expecting as far as the magnitude of the move after reporting earnings compared to historicals. If we have time, we'll go over some bullish bearish ideas. And of course, if you have questions, let me know along the way. I'll try to answer as many questions as I can.
Sounds good.
So right now we're on the pre-market report. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to filter out quickly the stocks that are market cap 20 billion market cap or higher. We'll take a look what's going on that list. So we see here 50 made the percentage gainers list, 34 in a percentage decliners list. So a little kind of neutral, maybe slightly more favored towards the bullish side at the open than bearish side. Got GSX up 10% in pre-market hours, RLX up 8.5% in the pre-market hours. Looks like NetEase is up 6%, but not on a lot of volume. So if there are no questions on the pre-market report today, Will, I'm going to go first take a look at Intel's earnings, just do like a quick overview what happened last week, and then we'll take a look at what's coming up on the earnings front. So just to save time, unless you have any questions in pre-market.
Nope, you can move forward.
Okay. So let's take a look at Intel here. And this is what happened in Intel. So they reported earnings. They're down 9.3%. And this is one of the things I brought up, kind of just want to show you again, because there's like I think, and I still get these emails, where did they beat earnings? Did they miss earnings? And I'm just going to show you here that a lot of times, and it's almost 50-50, a stock will beat earnings, just like here, Intel beat earnings expectations. So whatever these expectations are, remember, these are not Wall Street or traders' expectations. These are a handful of analysts following Intel and making their reports. Okay, so when we're talking about expectations, we're talking about, some analysts' expectations that follow the stock that could be working for some bank. All right, because you don't know Wall Street's or traders' expectations. They don't publish that anywhere. That's just embedded within their, with their own analysis, and then they're just trading around that. Having said, putting that aside, I just wanted to show you, well, what's going on here? Like, why, is Intel here, they beat here, by a healthy amount, pretty big amount, 42 cents. And even if you go down in history, it's hard to find something, a beat of that size. Beat here, revenues, but the stock was down 9.3% after reporting earnings. And this is like and this is really, really important, because what happens after reporting earnings to the stock is not these numbers alone here don't mean much. It's the story behind the numbers, right? So you have this earnings report. Here's your earnings per share. Some people will make the mistake immediately trading on that, but it's what's behind the numbers that's important. And you got to kind of dig deeper in there and figure out, are things getting better or worse as far as the future outlook of the company, right? Because that's what people want to know. Okay, this is what you did this quarter. What is the future outlook for your business? Does that, hopefully that makes sense to everybody as I'm moving along? Because
Yeah, you're good.
Okay. And I just want to emphasize, because I think a lot of people are like emailing me about these, like, misses and beats. And I just wanted to point that out. Like these, it's not in these top numbers, right? It's in the report. So let's take a look really quickly before I get and open up their report, their financials. Let's take a look what happened to Intel leading up to the earnings, right? So we kind of get a sense of what was the expectations from the price action leading up to the earnings. How does Intel usually behave after reporting in their earnings? And then we're going to open up and take a look at their financials and see, well, what happened. So here I'm going to go to the post earnings drift, and this is calculating after a company reports earnings, they reprice really quickly. So over here we see Intel is down 9%, right? They reported earnings. Everybody has clarity about the future outlook. They get to listen to what the management is saying. They recalculate all the numbers in their models, and then they get a new fair value. They reprice it. So boom, in one day, that should happen, because the information is out there. So that we have that, but between earnings, right now that we repriced, we got all the new information. Now there's more uncertainty what will happen the next earnings. So we got like usually 3 months, right, every quarter, and the stock will drift. And this stock will drift based on people's expectations of what will the next earnings be. How will Intel do their next quarter, right? So now we start here, we get this drift. So let's take a look. What does Intel typically drift, right? So here we see historically between earnings, there's a drift of 6.2%. So on average, Intel in those 3 months after reporting earnings and right before the next earnings, there's on average a drift of 6.2%. A one standard deviation move up or down, because it could drift lower, it could drift higher. One standard deviation move is 9.3%. Okay, so that's drift in between earnings. So let's take a look. Prior to reporting this earnings, 9.3%, it was down. This is what the drift was, 30.5%. In other words, Intel increased by 30.5%, gained 30.5% in between, it drifted in between earnings leading up to this last set. So you could see the expectations already were high. In other words, even if they beat, right, so much was priced in that maybe to the upside it's already muted. But if they say anything that's not so good, you've got a lot of air there, because we've already built up a lot of inflation into that stock, or appreciation, 30%, right? So we see that. And what is 30%? Well, that's 3 standard deviation, right? If a one standard deviation move is 9%, you got over 3 standard deviation move. So we could take a look here and see, like, here's the history, the last 12, and that's the biggest drift we've seen in the last 12. We could even go here, last 24, so you could expand it further and just take a look. How does this drift compare to historical drifts, and what did it typically do after having a high drift in between earnings? So just wanted to kind of show you the buildup into the earnings report. We had a pretty significant buildup. Now, I'm going to be, to make this report a little bit easier to read. I'm going to add a chart here. I think that will come out this week. And I think it'll just be easier to see, the magnitude of the drifts, especially the most current one. But hopefully people kind of get what I'm saying here. Well, if not, let me know, if you have any questions.
Everyone's been relatively quiet on it, so I'm assuming they get it. We are in a little bit delay. If you have any questions about what D is saying about the drift into Intel, ask him now. He's moving forward.
Okay. So, but we do see, just so you see, heading, in between earnings, 71% of the time Intel drifts higher in between earnings, 29% lower. That's in the last 24 quarters. Last 12 quarters, we see here 75% of the time it drifted higher. Let's take a look leading right up into the earnings and what it usually does after reporting earnings. So I'm going to go here to stock patterns. And here we see this is the stock behavior right around earnings. And this is what we typically see before earnings. Heading into earnings, it does relatively well, like you see here, especially starting 2 weeks ahead of earnings. For that 2-week period, we could see 92% of the time the stock runs up right into the earnings. So this is not including the earnings day, but 2 weeks prior, right up to the earnings, we get all positive numbers. 2 weeks prior to earnings has been historically the best time to start. After reporting earnings, day of earnings, it's kind of like 50-50 here. Like more, you see, it's almost 50-50. Half the time it gaps up, half time it gaps lower, a little bit more times it actually gaps to the downside than the upside for an average loss of 3.2%. We also see here that on average, the drift from the open to the close is more often negative than positive. 58% more of the time it drifts lower than higher, and on average, we see here day of earnings, 67% of the time it was lower, 33% higher for an average loss of 3.4%. So from a historical perspective, we see two things here: run up to the earnings, day of earnings, not so strong. Leading out of the earnings, also not so strong. On average, it tends to lose, between 1 to 1.6% heading out of the earnings. And we see these are the, 1 week, 2 week, 1 day, 2 day, 3 day, 1 week, and 2 week historical returns. So that's two things we looked at. We looked at the drift, post earnings drift. And we also looked at how it tends to do right around earnings. That's from a price action analysis. Let's take a look now from the report, what they said, and see if we could gain some insights in there. I'm going to go to the investor relations over here. So here we see that they reported, let me see here. So this is Intel. I'm going to open up their report, and I'm not going to read through the whole thing. There's lots of stuff to read through, but I'm just going to try to point out a few things that right away what you want to see. You want to try to look for their expectation. What are they guiding? Are they guiding higher or lower going forward? And then you want to kind of take a look at how their margins are doing. Are their margins improving? Is their revenue improving? So those are kind of like the first two things you try to look at before you kind of, read deeper into it. So I'm going to first just come down here. They give us some highlights here, and they give a gap and a non-gap. And typically this is what companies will give you. They'll give you two types of reports: the gap, which is the generally accepted accounting principles. That's how everybody reports on this SEC filing. And then they give you the non-gap because every company has their own nuances. Every company, not all companies are the same. So they look at metrics differently. And typically what you see is the expectations, the the traders who follow the companies are looking at non-GAAP numbers, right? So this is the more important number really to look at, because that's where people really say, well, show me, your non-GAAP number that's specific to your company. And we see here a few things I'm going to show you. So net income, right, they were comparing this from fourth quarter 2020, fourth quarter 2019. So how did the net income do from quarter to quarter? So we're comparing one quarter to the previous year's quarter. And we see here that net income was down 6%, but earnings per share was flat. So take a look at it. Down. Does this make sense to everybody? Net income was down 6%, but the earnings per share was flat. Does anybody understand why that could be the case?
Good question.
It's an open question to the community. If not, it's okay, but I'll explain. So the net income is their total. That's how much they totally earned. The companies, right? Total net income, what they earned after their expenses, and then you divide that up by the outstanding shares, and you get an earnings per share. But these can be different, right? We see net income was down, but the earnings per share is not down. And one reason could be, I didn't look deeper into it, but one reason could be is if you're buying back shares, if the company is taking cash that's on their books and buying back shares, that means the number of outstanding shares is decreasing. So even if your net income is going down, it's possible that your earnings per share could go up. In other words, it's possible. Let's go back to Intel here. So it is possible that this earnings per share increases even if your net income is decreasing, depending what the company is doing. So I'll give you just one example really quickly, and I'm going to make it an extreme example. Okay, let's say that the company made $1 million in net income. After all their expenses, they made $1 million. And if there's 1 million shares outstanding, right? If we take 1 million divided by 1 million shares outstanding, it's like $1 per share. That's their net income. Earnings per share, it would be $1. Now, let's say during the course of the year, let's say they have a bunch of cash on the books, and what they say is, let's buy back this stock. So instead of 1 million shares outstanding, the company buys back 500,000 shares, right? So now 500,000 shares, they buy back, then there's remaining 500,000 shares outstanding. So if the company makes exactly the same amount of net income, they made $1 million in net income. The previous year was $1. We concluded it was $1 per share in income. Now this year they made $1 million again, but they only have 500,000 shares outstanding. So then it looks like they made $2 per share in net income. But in reality, $2 earnings per share, not net income, $2 earnings per share. So earnings per share went up, but the company actually didn't double their earnings, right? The earnings didn't actually double. What happened is that the amount of outstanding shares declined or decreased. Does that make sense to everybody?
They're saying yes.
Cool. All right. So that's just one observation really quickly as my eyes are scanning here. I see that they're increasing their R&D. I guess that's fine, if you're increasing your research and development. Gross margins down. It's not a lot. It's not down a lot, but you never want to see your gross margins declining. It's never a good thing. But it does fluctuate. So that looks not like a huge number, but it will fluctuate a little bit up and down. And then obviously your revenue being down, you want your revenue increasing. So if your business is doing better, your revenue should be increasing. Down 1%, that's not so great. That's year over year. Then they'll give you some highlights here. Similar to what we were talking about, cash from operations, net income, operating margin. You see here down. This is year over year. This was quarter compared to the prior year's quarter. This is the entire year compared to the entire year of the previous year. So they're showing you those two types of breakdowns. The other thing is you want to take a look at their business out, and we'll talk more about cash from operations, free cash flow as we're rolling out, as I promised, as we're rolling out our fundamental features. I'll focus more on those. But let's take a look really quickly to see if they give us an outlook here. So here's business outlook. And this is what they're telling us. So remember, non-GAAP is really where we're going to be looking at. And their non-GAAP, they're telling us for the next quarter. So this is their business outlook. We just had the fourth quarter. Now they're talking about the first quarter, the next upcoming quarter. They're telling us $17 billion in revenue. That's their guidance. Operating margin, 30%. I think that's kind of in line with what they were doing before. And their earnings per share, $1.10. So let's take a look at these two. If this is their guidance, let's compare it to how their first quarter was the previous year. Are they good based on their outlook? Are we looking at improvements, or are we looking at declining revenues, declining earnings per share? So 17.5 billion, $1.10. Coming back here at Intel, I'm finding the first quarter, right? We just had the fourth quarter. They're giving us guidance the first quarter, so I'm going to compare it to the first quarter of last year. Last year, first quarter, they made $1.45. Now they're guiding $1.10. Do you see that? $1.45 last year, first quarter, $1.10. Does that seem good to anybody?
Let us know if that seems good. Your thoughts. We did get one, it's about a 30-second delay, D.
Sure.
But,
okay.
You're getting a lot of shout outs. Actually, Robert Black just said he thinks you could teach college level accounting if you so desire.
Thank you. Well, I try to think about how to explain it in the most simplified way. Usually it's just the visuals really that are in front of you. But here we go. So here, not so good. If they made $1.45 last year and their outlook is $1.10, that's not so good. So we're going to see that weigh in on the stock if that's in their guidance. The other thing, well, they're telling us $17.5 billion in revenue for the first quarter. Okay, how did we do previous quarter? 17.5. I'm finding the first quarter we're 19.8 billion. So obviously 17.5 billion is lower than 19.8 billion. That's not so hot, right? Now their guidance is telling us that if we compare it quarter to quarter, not so good. All right. So that's really quickly, just wanted to point out some highlights in that report. We looked at the expectations being built up in the stock price going into the report. We saw the report look like a beat, right? So if you were just looking at that and bought the stock, you wouldn't right away, you wouldn't have been doing too good. You wouldn't have been too happy that day, right? Look deeper into the numbers, listen to the conference call. You could listen to, even in the conference call, sometimes you'll have questions coming up from analysts, see how they're answering those questions. But when we look deeper in it, we're like, well, that's their outlook doesn't look too hot. And then you get this. Okay. There are no questions. I stayed on this for a little while, but I'm going to move on to the upcoming earnings.
Yeah, that was great. There is, just so you know, there's a lot of chit chat in the chat about GameStop. I don't know if we picked up on it this morning in the pre-market movers, but it's up 50%. And they're talking, there were a lot of questions about hard to borrow stocks and if we have any short stock information on the site, which I'm not
What
aware
is
of.
what
GME?
is the
GME?
okay? Okay, so 56%. Let me see.
Yeah, they're saying it's a squeeze.
So as Grant, so I don't know what I mean. I do see some headline news here, but I'll tell you really quickly. I'm going to go to the options chain, and all I see, and that's a lot of volume for options. 2 million. Heading into this, look at the implied volatilities were like through the roof on and it was up. That's how much it was up on
Day before, yeah. And this was literally a $2 stock. I don't know, 3 months ago, 4 months ago.
Yeah, here's the 52-week low.
Yeah,
that's a crazy. Yeah. So all I see here is that the implied volatilities are through the roof here. And you could see here most of it was on this this was the expiring month, so you could take a look here. And when we talk about hard to borrow, you see how all these are in green and these are in red. What this is saying is that the put call parity is out of line. In other words, in a perfect world, if you could short the stock, then this would create an arbitrage opportunity. But because the calls theoretically are relatively too low compared to the puts, right? Your synthetic, getting long the synthetic is cheaper than just getting long the stock by itself. Okay, so here I'll give you an example. If I bought, here's the 60 call, right? So if I bought the 60 call for $10.90, and then I sold the 60 put for $9.50, what's that? $1.40. I would pay a total of $1.40. Bought 1090, sold for $9.50. I would net pay $1.40. Add that to $60, so $61.40 is synthetically where I bought the stock. The stock's trading $65. So I'm basically making $3.50 under parity by doing the synthetic. You see, stock's $65, but I'm buying the call for $10.90, selling the put for $9.50. The difference is $1.40. Add that to the strike. Synthetically, I'm buying the stock $61.40. Why is it doing that? You can't create an arbitrage because I can't short it. If I could short it at $65, that's an arbitrage. I will keep that $3.50. What this is saying is you cannot complete that arbitrage because there's no way to short it, or the fee to short it probably exceeds that amount. And basically that means is if you put that on, if you can't short it, then you're just naked long, right? You can't hedge it off. So that's one way to look at if it's hard to borrow and difficult to short. Now, there might be too many shorts out there and there's no more stock to borrow, or just might be a stock that just doesn't have a big float to lend out. Does that help answer the questions?
Yeah.
Okay. We only have 2 minutes left. There was a question that came up, and maybe I didn't answer it that well because I went back and looked at the comments. When we're looking at a leveraged ETF, somebody asked, remember, why does it tend to go down, right? The leveraged ETF, like the double, triple ETFs. Why do they tend to kind of drift lower? Since I only have like a minute left, I'm going to give you an extreme example of what's happening in those leveraged ETFs. So remember, the leveraged ETF, it follows some index, and it says on a daily basis, if this stock, let's say it's a double, right? Let's say we're looking at a double long leverage. If this stock increases by 10%, well, the leveraged one should increase by 20%. If this stock decreases by 10%, then the leveraged one should decrease by 20%, 2 times the simple return on a daily basis. So let's take an extreme example. And let's say your index starts at 100 and your your leveraged ETF starts at 100 as well. So we're both starting at the same point, 100, 100. If, for example, that, I'm going to give an extreme example because I have a minute. If your index decreases by 50% in one day, if it decreases from 100 to 50, if it decreases by 50%, your leveraged ETF is basically out of business. It's down 100%, right? That's it. You're out of business. There's no way to go up. But let's just say it decreases by 50% and it doesn't go all the way to zero. It goes to $1, right? So now one went from 100 to 50. The leveraged ETF went from 100 to $1. Let's say the next day, that one that's your index goes from 50 back up to 100. So now it increased by 100%. That means the ETF that's $1 increases by 200%, right? So it just goes from $1 to $3. So you see in those 2 days, your index came right back to the same spot, but that leveraged ETF is $3. Went from 100 to 3. Just wanted to give you a really quick example. It's 9:30. I'm going to let everybody go trade.
Excellent. Great job, Dima. Lots of chat today. Thanks for joining us, everyone. Have a safe trading day. D, we'll see you tonight on the webinar.
Yeah. I'll join in tonight. So thanks everyone for joining. Stay safe. Have a great trading day. Hope to see you guys later tonight.